The media is there to sell you ads, sell you products. They are not there to help you with your investment strategy. And what I mean by that is if you turn into CNBC or Fox Business or some of the other financial channels, you're going to find people on there with many, many different opinions. And some of them might be telling you to sell your portfolio, go to cash, get out of the markets, things are going to collapse. These people don't know anything. They're essentially trying to tell the future. And as we know, the future is very hard to predict, and there's no accuracy.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 104. This week we're going to be talking about bear markets. I've been getting a lot of questions from listeners and clients about what they should be doing, if anything, due to the recent stock market decline. So I thought this would be a great time to talk about 5 tips for dealing with a bear market. So the first thing is understanding what is a bear market. And the definition of a bear market is when an asset class, and as a reminder, there's 5 main asset classes: stocks, bonds, real estate, commodities, and cash. You could put cash aside. So any of the other 4, stocks, bonds, real estate, or commodities, when they have a 20% decline in the value of that asset class. And this could take place, over a short period of time, maybe a month, or maybe it could take place over a number of months. But once we hit that 20% decline, that's technically when we're in a bear market. You might be wondering, well, how often do these bear markets happen? Well, they happen more often than we'd like. In the case of the stock market, as measured by the S&P 500, if we look back since 1980, there has been 6 bear markets that have occurred since that time. And the one we're currently going through would be the 7th. One in 1980, where the S&P 500 declined 27%. One that began in August of 1987, S&P 500 declined 33%. July of 1990 it began, and that declined about 20%. March of 2020, as we can remember, the stock market tech bubble bursted. That S&P 500 declined 49%. October of 2007 began the Great Financial Crisis, declined 57%. And most recently, the COVID crisis, and that declined 34%. So it does happen a fair amount. And you might be wondering, well, how long does it take to recover? For instance, the COVID correction didn't take very long, only 5 months, but the correction in 2007 took 49 months. The correction in 2000 took 56 months. So it can take a long period of time for that asset class, in the case of the S&P 500, which we're talking about, to get back to where it started before everything began. So my first tip for handling this large correction is to review your asset allocation. And what is your asset allocation? That is the mixture you have between those 5 main asset classes I mentioned before. The mixture, which is really important, is the amount that you have in the growth-oriented assets, which would be commodities, stocks, and real estate, versus more of the capital preservation asset classes of bonds and cash. The more that you have in stocks, real estate, and commodities, the more growth potential you have, but also the greater potential decline your portfolio has. That's the trade-off. The more you have in bonds and cash, or if you have no stocks, commodities, or real estate, you have very little decline or less of a decline, but you have very little growth potential. So getting a handle on what your asset allocation is, sometimes on your 401k statement, it'll say it right on there. If you have your money invested outside of your 401k, you should easily be able to figure that out. So understanding what that is, and maybe you didn't even know what your asset allocation is. Maybe you thought it was conservative, but you find out that you had, 60 to 70% in stock funds. That might still be the appropriate mix for you, but if you were going into this not understanding that, you would be a little bit more surprised. And you always want to have an idea of what your asset allocation has done in the past. And I'll put a link in the show notes to a chart that I put together. But I looked back over the 2008-2009 financial crisis because this was one of the most recent large declines that we have. As I mentioned, the S&P 500 declined 56%. And you can look at this chart to see what various asset allocations worst case scenario was during that time frame. For example, a 60% stock, 40% bond portfolio, which is somewhat moderate because you do have 40% of your money in bonds, did decline by 25% during that time frame. So that is still a large decline. It's not as bad as I mentioned before, the S&P 500 declining over 50%, but it still means that you lost 25% of your value and it took some time for you to recover your money. So you really need to understand that trade-off and always know what your asset allocation is, and you should have a target asset allocation. Tip 2 is to review your diversification. A lot of times people confuse asset allocation with diversification. Diversification very simply means don't put all of your eggs in one basket. Don't have all of your money in maybe one sector or just a few stocks. Maybe you have all of your money invested in a couple stocks and you did really well with these stocks leading up to the recent correction. Or maybe you'd focus more heavily on the technology sector because that was what was leading the market coming out of the COVID correction that occurred. The problem is that all trends come to an end, and you will definitely see more of a decline if your portfolio is heavily concentrated in one area or another. And sometimes you can benefit from that, but you have to understand that you might have much greater losses by doing that. So an alternative to that is being diversified, not trying to pick which sector is going to do the best or maybe which stock or handful of stocks are going to do the best. Rather, you have a broadly diversified portfolio. That's the strategy that I recommend to clients. You're broadly diversified across multiple sectors of the stock market. You're invested in many different stocks so that you're not going to have a portfolio that's going to be the best in one year, but it's also not going to be the worst. You're going to track the market. And generally, this strategy over time has proved to be the best because it's very hard to figure out with any consistency which sector or which small group of stocks are going to be the best ones to own. So definitely looking at your diversification. Maybe you are too concentrated and you want to get more broadly diversified. Tip number 3 is maintain perspective. The media is there to sell you ads, sell you products. They are not there to help you with your investment strategy. And what I mean by that is if you turn into CNBC or Fox Business or some of the other financial channels, you're going to find people on there with many, many different opinions. And some of them might be telling you to sell your portfolio, go to cash, get out of the markets, things are going to collapse. These people don't know anything. They're essentially trying to tell the future. And as we know, the future is very hard to predict, and there's no accuracy. So it's easy to get kind of, I would say, sucked into the negativity and buy into it and think that you should get out of the stock market. The problem with that is that if you miss the best days in the market, your returns over the long term will be significantly compromised. I'll put a link in the show notes to a chart that I really think hits this home. And that is a study that JP Morgan did looking at the S&P 500 over a 20-year period. And over that 20-year period, it was from the beginning of 2000 to the end of 2019. So that 20-year period, the S&P 500 had an average return of 6%. So not anything great, average return is 6%. But if you miss just the 10 best days of that 20-year period, 10 days, your return was cut in half down to 3%. That's per year. So that means that if you think, okay, I see the stock market going down, I should get out and I'm going to wait. And then when things look good, I'm going to jump back in. The odds of you timing that correctly are very, very low. I wouldn't say that they're zero, but they're pretty close to it. And what usually happens is that news will come out or sentiment will change, and it will change quickly. And all of a sudden you'll have some big up days in the asset class that you got out of, and you'll be really regretting missing that. So my advice is to stay diversified, stay with your asset allocation, and don't try to time the market. Another component of that might be don't look at your statements. I know that seems crazy. Why wouldn't you want to look at your statements? Well, it can become very overwhelming if you're seeing negative months after months of investment returns. And you might extrapolate in your brain that your investments are going to go to zero. And I truly believe that if you have a well-diversified portfolio, you're never going to see that. If you're properly diversified, you're investing across hundreds, if not thousands of companies, and you're going to never wake up one day and find out that all these companies went out of business. That's never going to happen. That's what you own when you own stocks. But you could have long periods of time of decline, and even it could take months and months or even years for things to get back to where they were. And you really have to have patience during that time frame. Tip number 4 would be to keep investing consistently. I get questions sometimes with a market decline like this. Should I stop investing in my 401k? Should I wait for things to come back in value? Definitely not. You want to be buying things when they're in a decline or when they're on sale. And that's essentially what's going on right now in the stock market. Now, it doesn't mean that prices, I should say, can't go lower from where they are. It's impossible to predict where prices will go. But we do know that right now, depending on what market you're looking at, the S&P 500 or the NASDAQ, things are at a reduced price of anywhere from 20 to 30% of what they were even just 6 months ago. So you're definitely getting a better buy in the market. So you want to keep investing, taking advantage of what's called dollar cost averaging, which means that if you're just investing, let's say, a fixed amount in your 401k, $1,000 a month, when prices are higher, you're going to purchase less shares, but when prices go down, that same $1,000 is going to buy more shares. And over time, that's really going to help you to have your portfolio build up and continue to grow, as you save for retirement. And tip number 5 would be that if you're unsure about what to do, if you need some reassurance maybe, or you're not sure what your asset allocation is, check in with your financial advisor. If you don't have a financial advisor, consider reaching out to Morrissey Wealth Management, because it's understandable that money is definitely emotional, and it's easy to get very overwhelmed, feel despondent when you see your portfolio declining in value. And it can really be helpful to speak with a professional who can help you review your situation in a non-emotional way, because it isn't their money, and help maybe add some clarity or maybe even improve your strategy if you're unsure as to what you should be doing for the long term. So I hope this helps give some clarity on how to deal with a bear market. It's certainly not fun to go through. No one ever wants to go through it. But if you are going to continue to build your wealth and even maintain your wealth, you are going to need exposure to the growth-oriented asset classes of stocks, commodities, and real estate. And you're going to have to go through these bear markets. As we've said since 1980, there's been a number of them. If you keep investing, there's going to be a number more of them. And you just have to understand that it's going to happen and have a plan to get through it. I hope this helps. And as always, I appreciate all the loyal listeners out there. If you haven't left a review, I'm always appreciative of a review. If you could take out your iPhone or just go online to Apple Podcasts, search for Retire with Ryan, and leave a 5-star review with a comment as to how this podcast has helped improve your perspective, helped improve your goal of getting to retirement, that'd be greatly appreciated. Have a wonderful week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.